So, over the past few days, Iran, the US, and Israel have engaged in missile and drone exchanges, with Iran responding with their own strikes across the Middle East, targeting many Gulf countries, trade, and air travel, posing a rising threat to infrastructure, especially oil, across the Middle East. So, today we'll be breaking down what's happening, why it matters from an economic perspective, and how oil, gold, and stocks are responding. So, what's happening? This map over here shows where Iranian strikes have occurred, including parts of Saudi Arabia, Bahrain, and the UAE. These strikes pose a serious threat to civilians and infrastructure, along with increasing the possibility of escalating the conflict and bringing more nations into it. Now, when military activity increases in this region, it raises concerns about the supply of oil, propelling oil's price. Now, even if infrastructure isn't completely destroyed, the risk premium still goes up. Insurance and shipping costs increase dramatically, and this added cost increases the oil prices due to the increased risk of transporting it from this region. Now, this narrow strip of water is one of the most economically important locations on the planet. The Strait of Hormuz is responsible for transporting roughly 20% of the world's crude oil, with 80% of oil passing through the strait heading to Asia, which will then have a domino effect on goods produced and transported from there to Europe and America. Now, this is still a developing event in the region, and although it is not very clear as of yet to the extent of the closure of the strait by Iran, there is still a very real threat to it if oil tankers are now being struck. Oil reacted to this news by jumping nearly 10% in just the past 2 days, with reaching a high of 9% just yesterday before moving back down. Now, this move in oil is being driven mainly by a fear of supply and not from a confirmed shortage. But if oil remains elevated for weeks rather than days, the economic consequences will begin to compound. Transportation costs will increase, airlines will be under financial pressure, and so will the manufacturing costs also be increasing. And eventually, the consumers will end up paying for everything more, from fuel to food. Now, let's talk about gold. On Monday, the 2nd of March, gold pushed higher as investors moved into safe haven assets, as risk and uncertainty increased globally. When geopolitical uncertainty rises, money often moves toward protecting its value, and gold has historically been a way to protect against war risk, currency instability, and inflation. But yesterday, the 3rd of March, gold pulled back over 4%. This is because markets are now trying to balance two opposing forces: a geopolitical risk on one side versus a macroeconomic pressure on the other. Now, the dollar has now been strengthening over the past few days due to higher inflation concerns, which means a higher interest rate to then help control inflation. This imbalance between these two risks is causing these swings in the gold price. Now, looking towards stocks, Palantir was one of the many stocks that bounced on Monday after the markets opened, ending the day up nearly 6%. Although it is officially a technology company, it has many contracts with the US government on surveillance, defense analytics, which boosts its shares as the defense industry now stands to benefit if the conflict and instability continue in the region, leading other defense companies such as Lockheed Martin, Raytheon, and Northrop Grumman to also go up in value. Then you also have oil producers like ConocoPhillips that also moved up on Monday. This positive move was caused by the higher oil prices, as a higher market rate means that they can now sell the oil for more value, while their costs for extracting and producing the oil remain fixed, boosting the revenue and profit expectations. On the other end of companies that benefited from high oil prices are the travel companies that did not benefit from these high prices, such as Norwegian Cruise Line Holdings, which faces pressure from this high oil price and the shares falling over 3% on Monday alone. Many other cruise line companies and airlines also fell after oil surged on Monday, as this results in a higher cost for one of their main expenditure. Now let's look deeper at the conflict's broader economic impact. In January 2026, fuel prices were actually falling in the US, with fuel and gasoline greatly down. Energy was down roughly 0.1%, helping keep the overall consumer price index, the CPI, around 2.4%. This was in line with expectations and signaled a cooling trend in inflation. But if oil remains elevated due to sustained conflict, inflation could now reaccelerate as prices are pushed higher by the higher energy costs. And if that happens, the possibility of interest rates being cut soon becomes difficult. Now, overall, oil is up due to a possible disruption to its supply, pushing up oil costs and pushing down travel companies. The higher oil price and instability and conflict in the Middle East also boosted shares of energy and defense companies. The pressure from possible higher oil prices is also raising fears of re-accelerating inflation, reducing the chance for an interest rate cut soon, and risking the fragile job market and the overall economic activity. But if tensions do cool, oil will move back and the volatility will fade. But if the escalation continues, the energy prices stay elevated, the inflation risk rises, and the markets continue to remain unstable. Alright, well, that is it for this video. Thank you for watching, and I will see you next time.